Oh, yes, it has been. In fact, let's discuss this sector forward and where is it that one finds investable opportunities. Abneesh Roy from Nuvama Institutional Equities joins in on the show right now to discuss exactly that. Abneesh, hi, morning. Great to have you on the show. Abneesh, QSR demand appears to be recovering with same-store sales growth improving across most players. Is this just the beginning of a sustained recovery or are we still seeing a low base effect play out?
Hi, good morning. Thanks for having me. Yes, definitely the sector looks interesting because after 2, 3 years of very muted demand, we are seeing a recovery. I don't think this is a single quarter phenomena. I think this will continue because of 2, 3 things. If you see Mrs. Bector's, which does the back end for many of these players, they have also called out that after many quarters, they are seeing a recovery across many players. Second is if you see broader urban consumption, we are seeing strong growth everywhere, right? So if you see, even in terms of paints, we are seeing double-digit growth come back for all the legacy player, and even for the new players. Similarly, if you see Nestle, which is more indexed to urban consumption, they have seen one of the fastest growth at 25% plus. Even Colgate, which has its recent analyst meet, they also highlighted that urban consumption has come back. We have seen urban consumption do well, even for Alcobev, for example. So I will say that QSR looks interesting, not just because of the base effect. I think what companies are doing different is clearly they are targeting the more affordability also. So below 100 rupee and below even that, some of the pricing has been introduced to attract new customers and customers who are looking for affordability. Second thing is clearly what we are seeing is innovation funnel remains strong. And third is 2, 3 years back, there was very sharp expansion by most of the QSR players. Now on a higher base, the expansion levels are also lower. So that also means slightly lesser competition in the overall segments we are seeing. We would expect that burger will grow faster than pizza, and that's why we like RBA the most in that space. But I think even Jubilant Foods will see some recovery in the coming quarters. It's a broad-based recovery which will continue.
Abneesh, just trying to understand how is in your read through recovery in pizza. Do you expect that to come through fairly quickly? Do you see some delay in that? Would therefore burgers be still the go-to in terms of the business?
No, I think what we see is clearly RBA will be faster growth, so burgers will grow faster. Even in Q1, if you see, RBA saw almost 12% SSG, while Jubilant Foods, Domino's saw low single digit, and that was also seen in the other two listed companies, Sapphire and Devyani. So I would say that definitely in terms of affordability and competition, at this juncture, burger seems to be in a better place. What we are also seeing in Q1, one new trend is dine-in also seems to be coming back. And if you see burger clearly from a dine-in perspective is more suitable because that is something in pizza which is already maxed, right? If you see for Domino's, already very big chunk is already in delivery. So that also is a positive for burger space. So we would expect that, yes, even in Jubilant, we will see SSG recovery because in Q4 and Q1, there was an impact of very high gas pricing and gas availability to some extent. So yes, recovery will be there even for Domino's and Jubilant. Definitely Popeyes is doing extremely well. Company for the first time shared numbers for Popeyes. I think very good numbers, 96,000 kind of average daily sales. That's very good number. And obviously they are given a guidance of 1,000 crore revenue for Popeyes in the next 3 to 4 years. I think the entire space will see recovery, but from a overall, how you see the stocks have corrected, right? Restaurant brands, RBA, post IPO, if you see, it kept going down. So the correction what we have seen in RBA is slightly on the higher side, but even in Jubilant Foods and the other QSR stocks, correction from the peak is almost 40-50%. So I would expect that in spite of the rally which we have seen in the last 2, 3 months, in the next 1 year, we see more headroom for stocks to do well, even in Jubilant Foods and rest of the space. But from a overall, what we see catch up and highest growth, I think RBA should continue to be top tier within QSR in terms of growth.
Interesting. On the price hikes and the commodity adjustment though, Abneesh, most players have taken only 1 to 2% of a price hike. The cost relatively benign so far. How much room is there for further pricing without hurting the demand recovery?
So I would say that in both QSR and broader FMCG, what we are seeing is companies are making sure that growth is the number one priority. So if they want to absorb some gross margin pressure, because yes, there is a inflation, right? In Q1, you may not have seen much of gross margin inflation, but because of the Iran crisis, a lot of things have gone up. So if you see, apart from that, El Nino also, the dairy costs are going up. So cheese cost will go up. Some of the logistics costs will also go up because of the crude and petrol prices, diesel prices, and gas prices also going up. So there is inflation across economy, across every industry, and across the world in the coming Q2, Q3. That will be there even for QSR. But what companies are thinking is let us absorb 50-60% of this inflation and try to take a price hike from for rest of the inflation. But whole idea is that they want to drive double-digit sales growth, and that can absorb a lot of the cost like the staff cost, advertising cost, etc., and operating leverage benefit that will translate into. So the whole idea is have some level of gross margin pressure, but because of double-digit sales growth, I think operating leverage will take care of the margin. So that's why what we see is price hikes will be a bit minimal, discounting is getting reduced, more affordability is getting driven. Some price hikes are happening, so maybe low single-digit price hike is what I think will continue. But idea will be to drive operating leverage to double-digit revenue growth.
Okay. Abneesh, I want to switch over to paints. Try and get a sense as to those numbers were extremely strong across the board. You've seen Asian Paints promoters buying very small quantities, but buying nonetheless. Do you expect the kind of earnings delivery to sustain now? And we've seen a meaningful pickup, right? Q1 FY27 on the decorative side, on the overall paint side as well.
Yes, Q1, most of the legacy player, even the new players like Birla all have done well. I think from a revenue growth and volume growth, that will continue. In Q1, definitely on the margins, companies did quite well. In Q2, you will see across the board some level of gross margin pressure in paints, FMCG, and many other consumer sectors, because the real impact of Iran crisis in terms of cost is in Q2, not in Q1, because most companies have 2 to 3 months of inventory. That's why that did not impact Q1 too much. But in Q2, it will be there. But from a revenue and volume growth, my sense is all the companies will maintain the momentum. So we expect broadly 15% kind of revenue growth for the India part of the business across all the legacy paint companies. The new paint company, obviously, the base is favorable because they were ramping up. So Birla Opus will grow faster. But what we see is now it's a healthy coexistence between the new player, Birla Opus, etc., and the legacy players. Second is on the EBITDA margin, what I just now discussed on QSR. I think that will apply for paint companies also. That yes, in Q2 there will be some gross margin pressure YOY for many of the paint companies. But on the EBITDA margin, I think the impact will be limited because of the revenue being double-digit growth. Operating leverage benefit will come in.
So, Abneesh, are there any picks when it comes to paint stocks? Where is it that you see a better risk reward?
So if I see growth-wise, Asian Paints has done quite well with 16% India growth. But if I marry that with the valuation, etc., what we are seeing currently, mid caps, small caps are doing better than large caps. So in that space, I think Indigo Paints is something which we like. We have a buy there. So I think in the current context, Indigo Paint is growing faster than the overall industry. But in Q1, the gap was limited. They grew faster than the legacy paint companies, the other bigger legacy paint companies. But the whole idea is that Indigo Paint should be able to grow even faster. So if the sector grows at 15%, they have an ambition of at least 20 to 25% growth. So Indigo Paint is one good company there. Coming to the larger caps, of course, Asian Paint is something which we always see comes back. So 1 year, 2 year back, the stock and company was completely out of the radar. It is coming back. We need to see what happens on the CCI competition, that case which is happening for Asian Paint. We need to see on that. But operationally, Asian Paint is doing quite well. We like that company also. And I think because of all this Iran volatility in terms of war, because no one knows where the peace talks are, that has delayed any price cut because there was an apprehension that the 11-12% price cut which the industry has taken, they will soon cut that and reverse it back. But because of lack of clarity, I think it's a good thing. So the price cuts will keep getting delayed. We don't expect any price cut before Diwali. So that gives us confidence that yes, in Q2, some gross margin pressure can be there. In Q3, my sense is industry should be able to maintain or expand its gross margin because now the crude is in that narrow range of $85-$95. The price hikes of 11-12% fully covers for that. So in Q3, we don't see an issue. Q2, there could be some transitory impact.
Understood. Abneesh, so great having you on the show today. Thank you so much for your time and insights on both paints as well as what one is seeing across the QSR segment.
Thank you.